Welcome back to Investing Talk Podcast. Our mission here is really to distill complex financial information into essential insights. We want to help you navigate the markets feeling informed and confident, definitely not overwhelmed. Today, we're zeroing in on a question many of you might be thinking about. Is rocket companies a good time to buy now? To tackle this, we've pulled together it's a fascinating stack of sources. We'll start by looking at the broader economic currents, specifically how the Federal Reserve and interest rates are shaping the housing market. Then we'll shift gears for a detailed investment analysis of rocket companies itself. Our goal is to connect those big macro trends directly to the specifics of what's happening with a company like Rocket, giving you the full picture. Before we unpack all of this, if you're finding these insights valuable, remember to subscribe to our show, like this episode, and maybe leave a comment. Your feedback really helps us reach more curious minds. And hey, if you'd like us to look into a specific company in a future analysis, just let us know in the comments below. You can also consider buying us a coffee to support our work. Every bit helps.
Yeah, what's truly interesting here is just how intricately connected these pieces are. I mean, the overall health and direction of the housing market, alongside where interest rates are going, fundamentally sets the stage for any company in this space, especially one as prominent as rocket companies. We absolutely need to establish that macroeconomic foundation first.
Okay, let's unpack the Fed's recent moves then. Our sources tell us that in its fourth meeting of 2025, the Federal Reserve decided to leave its benchmark interest rate unchanged. Now, this followed a series of 3 consecutive rate cuts that closed out 2024, a half percentage point cut in September, and then quarter-point cuts in November and December. So for many of us, the immediate thought is, great, lower rates mean lower mortgage rates, right? But the reality seems a bit more complex. What does this decision and those prior cuts really mean for the housing market?
That's a really crucial point because the relationship isn't always, well, as direct as we might assume. While it's true that mortgage rates did fall sharply, I think it was from 8.01% in October 2023 down to 6.2% in September 2024, leading up to those initial Fed cuts. They then surprisingly climbed to 7% in January, and that was after the Fed had already begun cutting. This highlights a really important distinction. The Fed doesn't directly control mortgage rates. Its benchmark rate influences short-term lending, yeah, but mortgage rates, those are long-term loans, they march to a slightly different drum.
Right, so if the Fed isn't directly dictating mortgage rates, that definitely complicates the picture. What are the primary drivers then, and why do we keep hearing about the 10-year Treasury yield?
Excellent question. Mortgage rates tend to move pretty much in lockstep with 10-year Treasury yields. Think of these long-term government bonds as a benchmark, okay? Lenders use their yield as a basis for pricing long-term loans like mortgages. When Treasury yields go up, mortgage rates generally follow. Now, what's been driving these yields higher? Well, our sources point to things like stubbornly high inflation, faster than expected economic growth, and even worries about escalating government borrowing. Greg McBride, he's Bankrate's chief financial analyst, really emphasizes that for mortgage rates to come down meaningfully, inflation needs to get back on track towards the Fed's 2% target. Lenders and investors are always watching the Fed, of course, but their interpretation of the Fed's actions and their outlook on inflation and growth that heavily influences those 10-year yields and, in turn, home loan costs. Just for context, 30-year mortgage rates averaged about 6.86% as of June 18, 2025. That's after briefly touching 8% back in 2023.
Wow. It's fascinating how many layers there are. So with these higher than expected rates, what tangible impact have they actually had on the housing market? We've certainly heard a lot about a slowdown.
Indeed. Yeah, the Fed's rate hikes through 2022, which saw rates jump from, 3.4% in January up to 7.12% by October. That definitely put the brakes on the market. Home sales dropped sharply. That was a clear sign of reduced activity. But here's the surprising part, maybe a bit counterintuitive. Home prices actually hit record levels. The nationwide median existing home price for April 2025 was $414,000. That's a 1.8% increase from the previous year, and not far off the all-time high of $426,900 from June 2024. It really suggests home values are driven by a complex mix of factors, not just interest rates.
That is a significant disconnect for many of us trying to make sense of this market. Sales are down, but prices are up. How do we square that circle? Are there some underlying mechanisms at play keeping prices high even when demand slows?
Well, if we connect this to the bigger picture, housing economists really highlight a few key things. One is just a persistent supply shortage. Simply put, there aren't enough homes being built or coming onto the market to meet the underlying demand. Another factor is the homeowner lock-in effect. Many existing homeowners refinanced into those ultra-low mortgage rates during 2020, 2021.
Oh, yeah, absolutely.
And they're really reluctant to sell now and trade up to a significantly higher rate on a new mortgage. So that keeps inventory tight. And finally, strong job growth and rising incomes in many areas continue to support buyer purchasing power, even with higher rates. These factors, plus major life events like marriage, having a child, or job change, they often prompt home purchases regardless of rate cycles. History supports this resilience too. In the 1980s, rates hit 18%. That sounds almost unbelievable today.
Crazy numbers.
And in the 1990s, 8 to 9% was common, yet people kept buying homes. This current slowdown, it looks more like an overheated market returning to a more sustainable level rather than signaling a housing crash.
That historical context definitely helps put things in perspective. So, if this is a return to normalcy, what's the forecast for rates moving forward? Will this continue, or are more shifts expected on the horizon?
Well, our sources are actually projecting significant rate cuts in the coming years. The expectation is for another 2 percentage points in cuts to the federal funds rate through end of 2027. That would bring it down to a target range of 2.25% to 2.50%. This forecast seems driven by a predicted shift in the Fed's top concern, moving away from inflation towards economic growth, even with a temporary inflation uptick we might see from tariffs. So for you, the listener, what that means for mortgages is that the 10-year Treasury yield is expected to slide down to maybe 3.25% by 2028, and the 30-year mortgage rate could fall to 5.0% in 2028 from a 2024 average of 6.70%. So yeah, lower rates are definitely projected down the road.
Okay, so with these projected rate cuts, what's the tangible impact for someone looking to buy a home, especially thinking about affordability?
A continued decline in mortgage rates would certainly ease the affordability crunch. It's currently at its worst level since the mid-2000s housing bubble, so any relief is welcome. But it also creates a new, maybe paradoxical challenge. Lower rates could draw more buyers back into the market, right? Which might just intensify the ongoing shortage of homes for sale.
Ah, right. Good point.
It's a delicate balance. We could see a period where affordability improves, but competition for the homes that are available remains pretty fierce.
Okay, so for our listeners who are maybe prospective home buyers or current homeowners, what are some key next steps or practical tips to consider with these volatile rates?
Greg McBride again, he advises keeping an eye on inflation more than just the Fed's direct statements. Inflation is really the underlying current driving things. Beyond that, savvy shopping for a mortgage can save thousands. Lenders are pretty eager for business in a slower market. Even small differences in percentage points can save you a ton over a 30-year mortgage. It's like finding a hidden discount takes effort, but pays off. He also cautions against adjustable rate mortgages or ARMs. He notes there's little upfront savings these days, maybe half a percentage point for the first 5 years, compared to the significant risk of higher rates later, especially with newer ARM products changing every 6 months.
Good warning.
And finally, for current homeowners needing funds, considering a home equity loan or a 8 ELOC that's a home equity line of credit can be smarter than refinancing a great low-rate existing mortgage at today's higher rates. Even if the 8 ELOC rate itself is higher, you preserve that great rate you already have on the main loan.
Got it. So we've laid the macroeconomic groundwork. We've talked Fed, interest rates, housing market dynamics. Now let's bring it back to our original question. Is Rocket Companies a good time to buy now? How does all this economic movement affect a company like Rocket?
Right. Rocket Companies, which operates across mortgage lending, real estate services, and personal finance tech, it's fundamentally highly sensitive to these broader trends, particularly interest rates and the overall health of the housing market. Their business model really thrives or struggles based on these external factors. Let's really break down their investment analysis based on our latest information, starting with their core business and moving to the stock. Okay, looking at their fundamentals. Rocket reported adjusted revenues of $1.3 billion in Q1 2025. That was right in line with their guidance. However, their total revenue showed some softness. It dropped to $1.037 billion from $1.384 billion year over year. What's maybe more striking is they also reported a GAAP net loss of $212 million in Q1 2025. Now, for our listeners, GAAP stands for Generally Accepted Accounting Principles. So GAAP net loss signals weak recent profitability compared to the net income they had in the comparable period last year. Their profit margin is very slim, only $2.77 million in net income over the trailing 12 months, and earnings per share, or EPS, is negative at negative 2.54.
So, strong revenue figures, relatively speaking, but that isn't translating into actual profit. That's a common challenge, right? Especially in dynamic markets. It tells us they're selling, but maybe the cost of doing business is high. What about their competitive edge then? Do they have something truly unique?
They absolutely do. Rocket has cultivated this unique platform that integrates home search, loan origination, and loan servicing. All while partnering with big players like Redfin and Mr. Cooper. Our sources suggest this integrated model creates a powerful ecosystem. It captures customers at various points in their home journey. This approach could potentially reduce customer acquisition costs and build strong loyalty. That's a significant competitive advantage in a fragmented and highly competitive mortgage market.
Okay, that makes sense.
However, their profitability challenges and the inherent cyclicality of the industry. Those remain significant risks that investors have to weigh against this advantage. Specific debt figures weren't highlighted in our sources, but given their business model involves mortgage-related liabilities, their overall leverage is definitely something you'd want to scrutinize in their SEC filings.
So that integrated platform is a plus, but the market often comes down to the numbers. How does their current performance and future expectations translate into valuation metrics?
Yeah, let's look at valuation. Their forward PE ratio is 40.64. Now, the price-to-earnings ratio tells you how much investors are willing to pay for each dollar of a company's future earnings. A forward PE of over 40 is, well, quite a premium valuation. It suggests the market has really high expectations for Rocket's future profit growth, despite their current losses. Their trailing PE, which uses past earnings. It's an astronomical 10,850.50, essentially meaningless because of that negative trailing EPS we mentioned.
Wow, yeah.
The stock also pays an attractive 5.32% dividend yield, which catches the eye. But its sustainability is questionable given the softness in earnings. It's always important to check if a dividend is really supported by profits or if it might be at risk.
So the market is pricing in a lot of future hope for Rocket, even with current struggles. What do the analysts, the professionals digging into these numbers actually think about its current price, given all these factors?
Well, analyst consensus price targets average around $14.20. That implies a slightly negative expected return of about minus 5.5% from current prices near $15. This indicates the market is indeed cautious. It's pricing in both the growth potential from their platform and the significant risks from current unprofitability and market cycles. It's definitely not a unanimous buy signal from the analysts.
Okay. And beyond the fundamentals and valuation, what about the technical picture? How's the stock actually behaving on the charts?
Technically, Rocket Companies has recently traded in a range near $14 to $15. There seems to be some resistance around $15.29 and support near $14. Its 52-week range is quite wide, from $10.06 up to $21.38. That indicates significant volatility. And for our listeners, volatility is also measured by beta. Rocket Companies has a beta of 2.29. That signals high volatility relative to the broader market. A beta above 1 means its price tends to swing more dramatically up or down than the overall market. There was a recent price uptick to $15.75 and strong trading volume that coincided with analyst upgrades from Jefferies. That suggests maybe some short-term bullish momentum, which can be interesting for traders.
So it sounds like a bit of a bumpy ride, highly sensitive to market shifts, but maybe with some recent positive signals making it interesting short-term. What's the latest news influencing the stock, and what are the upcoming events that could really shake things up?
Well, latest news includes those Q1 results we discussed, with the net loss despite solid adjusted revenue. We also saw some strategic partnership announcements. These aren't just press releases. They represent real efforts to expand their ecosystem and reach. That could drive future revenue growth and market share, which is crucial in their competitive industry. Jefferies' upgrade clearly sparked some trading volume, showing the market is sensitive to analyst sentiment. Overall, though, analyst sentiment is generally cautious. Mostly hold consensus, with price targets ranging from $13 to $18 from firms like RBC, UBS, and Keefe, Bruyette & Woods.
Okay.
A major upcoming catalyst, and one investors will be watching very closely, is their next earnings release. That's expected on July 31st, 2025. It'll provide crucial guidance updates and hopefully clarify the near-term outlook on their profitability. And, of course, those broader macroeconomic factors, especially interest rates and housing market conditions, will heavily impact their mortgage business performance going forward.
That makes sense. So considering all that, what are the key risk factors people should be aware of with Rocket Companies?
Yeah, there are several risks to keep in mind. Stock-specific risks include continued unprofitability and high operating expenses. Their reliance on the cyclical health of the housing market and mortgage refinance volumes means their business is just inherently sensitive to interest rate swings. Sector risks involve potential regulatory changes in the mortgage and fintech industries. Those can always shift the landscape, and of course, intense competitive pressures from both traditional lenders and other tech-focused companies. And as we noted, that high beta of 2.29 means significant share price volatility. But on the plus side, liquidity appears good due to high trading volumes, so you generally won't have trouble buying or selling shares if you decide to.
Okay, so if we pull all of this together, all the macroeconomic insights, the fundamental analysis, the valuation, the risks, was the final analysis for someone wondering if now is a good time to buy rocket companies.
In summary, look, Rocket Companies holds a strong market position with its integrated fintech and real estate services. That's a powerful competitive advantage, no doubt. However, near-term profitability is weak, and its valuation is relatively high given that earnings uncertainty. The stock's high volatility and the mixed analyst sentiment, it all contributes to a cautious stance. The overall rating, based on our sources, is kind of middle of the road, a 5 out of 10. For new investors looking for maybe a better risk-reward entry price, a range of $13 to $14 might offer a more attractive entry point, especially if the stock dips below its current levels near $15. This is really a company with strong potential if they can execute on profitability, but it definitely comes with considerable risk right now.
So given those dynamics, who is this stock most suitable for? And what strategies might different types of investors consider here?
Well, short-term traders might try to capitalize on the volatility around earnings releases and news events. But they'd need to use tight stop losses, maybe around 7–10% below their purchase price because of that high beta we talked about. Take profit targets could potentially be near $16–17 if positive earnings or other catalysts emerge. For long-term investors, though, patience for fundamental improvement is absolutely key. Plus, close monitoring of those macroeconomic and housing trends we discussed earlier. It's less about timing the market perfectly and more about whether you believe their integrated model can eventually translate into consistent, strong profitability. If that profitability doesn't materialize, even a strong platform won't sustain the stock at its current valuation indefinitely.
This has been a really comprehensive exploration of the complex interplay between the Federal Reserve, the housing market, and a specific company like rocket companies.
Yeah, what consistently stands out to me is how these broader economic currents fundamentally shape the potential of individual investments. It's a reminder that even when a company faces challenges, its underlying competitive advantages can still position it for significant future growth, provided it can navigate the shifting tides.
Absolutely. So what does this all mean for you, our listener? Perhaps it's this. In the world of investing, understanding the why behind the numbers, connecting those macro trends to micro realities, is just as crucial as the numbers themselves. The question isn't just, is it a good time to buy? But maybe more like, what's driving this particular moment? And what's the broader landscape suggest for the future? It's definitely a nuanced dance between opportunity and risk, something to mull over as you navigate your own financial decisions. Thank you for joining us on Investing Talk Podcast. We hope this exploration has given you a clearer picture and some valuable insights. Until next time, keep learning.